All right, traders, welcome back to the channel. I'm Brian, and in today's video, we're going to be talking about what actually moves price in the market. Specifically, we're going to be talking about market orders. Now, I will do a follow-up video covering limit orders, but for today, we're going to be diving deep into market orders specifically. And yes, I know on the surface, right, it seems like a very basic concept, simple market orders, right? However, my question to you is this. Do you actually know how price movement is affected by market orders in the market? Okay, because this is a foundational concept in trading that I rarely see anyone really talking about, at least going in depth on this. So let's go ahead and do a deep dive into this topic on market orders in the market. All right, so the first thing I want to do is start off with a simple yet fundamental concept, and that is something we all need to understand. See, market orders create price movement, okay? So market orders move the price in the market, where limit orders limit or they stall price movement at a particular price level. Now, this is very different from order size. You can fill a lot of orders at or near a specific price point. So limit orders are not limiting the amount of orders at that price. However, once all orders at a specific price point is exhausted, it is now the market orders that will allow that price to move to the next level. And this is a key concept I want you to take away from here, okay? Because market orders is basically you're demanding immediate action. You're basically walking in and you're paying the asking price, no questions asked. This is what I need to do, right? And there is no, and if there's no liquidity, that is, if there's no liquidity at that price, okay, basically no inventory at that specific price, then the price needs to move to the next level to fill that order. And this is where you'll see this concept of slippage come in, okay? So if you're trying to fill a large market order, that price needs to move a lot to eat up all of the orders in a specific price range if you have, again, a large market order and there's not enough inventory at a specific price, right? So you're gonna see that slippage in price where you're gonna get filled because it has to basically run the range to fill that order size. Now, most price movement in the market, right, is not a result of retail traders. Rather, it is the big institutions, the market makers, and yes, the algorithms that will often drive price movement. On the retail side, let's talk about that for a second. Okay. Market orders tend to be driven by the urgency, okay, fear of missing out, okay, a panic selling, kind of the FOMO. Some sort of catalyst like a news event can create momentum, and here's the key. Okay, as traders basically start to panic sell, let's say, trading algos are actually designed to pick up on this imbalance, okay, where traders are panicking, like say on news. And then the algos see this and they start issuing their own market orders against this, right? So it's creating this feedback loop, and then you can see price move significantly, right? So that's one component, you know, to take into consideration. But again, that's just one small piece of the pie, because the major price movements actually come from institutional order flow, right? And that's something I want to dig into here. So this is going to be things like forced liquidation and margin calls, okay? This is going to be things called delta hedging, portfolio rebalancing, and stop hunting. This is where you see the majority of price movement in the market driven by market orders. All right, so now let's first talk about this first concept, forced liquidation and margin calls. This is a big one, okay? This is a massive non-discretionary source of market orders. When a trader's account falls below their margin requirements, okay, the brokerage system is designed to automatically issue market orders to close that position. They have to liquidate position off their books, right? And you hear this term often called basically like a flush in price, right? This is where a large up or down move, usually like a down move, which can trigger a cascade, you know, of these forced liquidations, these margin calls, depending on which side of the trade you're on. So if you're on the buy side or the short side, right, this can trigger that. And the algos from these institutions and these firms, right, they'll basically start liquidating price. Now, the other thing is this, they also compete with each other. The algos actually compete with each other and the market makers, so they're looking for this type of weakness in the market. So the own algos will start selling against other market makers' positions, allowing them to buy back at a better price. And this is the classic like flush and rally pattern you will often see in price, where the price will flush down, absorbing all this liquidity and force all these stops to trigger, right? And again, stops are market orders, and it's just going to keep running that price. And when you see this forced liquidation and margin calling basically occurring, when stocks especially gap down overnight, they'll basically gap down, hit all the the margin calls, okay, they'll flush down, knocking out everybody's stop, right? This is, again, the classic stop hunting, okay, because stops, again, are market orders. They're going to flush the stops and then also hit a point where, you know, all that liquidity has been basically knocked out, turn around and run the other direction. It's very common. And this also happens on the upsides where stocks will gap up, triggering again all the short positions, right? Getting people into a short squeeze and knocking out all the stops there. Again, running up, hitting everything, turning around and running down. Okay, this is the classic, you know, patterns here, whether it's a gap and trap, again, and also like other patterns where gap and go, where they'll gap open and then just keep taking off, right? And again, a lot of this happens because market orders are pushing the price and aggressively moving that price to move in one direction or another. So when you see the market gap, or you see basically the stock flush and then rally back, you now know what exactly is going on. Okay, there's a high probability that some of those orders, some of those market orders are being driven by overnight margin calls, forced liquidation. They're forcing the liquidation to close those market order close positions using market orders for people basically who are outside of their account size. Okay, next let's talk about institutional portfolio rebalancing. As retail traders, this really doesn't impact us at all. And it doesn't really create any kind of these crazy price movements either, okay? We're not looking for wild swings in prices. Rather, this is something you should be aware of because this is something that institutions do to rebalance their portfolios because you can see this trading activity occur as price basically goes sideways. And this can be something that it could be spread out over one day or several days before a large price movement occurs again. This is where you see large mutual funds or ETFs receiving billions basically of investor money, and they must buy the underlying stock or they are directed to sell off a massive position. Now, they can't just jump in with a single giant market order or a single trade. That would cause a huge immediate price imbalance, right? And spike or crash basically the market. That's going to really hurt them also on their fills. So what institutions use is they use execution algorithms to break up their order size into smaller pieces, and throughout either hours or days, you're going to see this basically where the price gets stuck. Okay, you got a narrow price range for a long period of time, and it's just basically bouncing between that range and going sideways, right? And this is part of the accumulation or distribution phase in action. And once all the large orders, right, from this execution algo is filled, that is when you're often going to see larger price movements right after that, okay? And this will often be something like a new trend starting, okay, new up or down trend. And this is a classic signal many swing traders look for. They look for the sideways movement, all right, as it eats up over time, and then they're waiting for basically that breakout. That's something to be aware of, but what's driving that is the market orders over time, right, that an institution is trying to either accumulate or distribute basically a large position size. Okay, next let's talk about delta hedging by market makers. Okay, what the heck is this? It sounds really cool, delta hedging, but what is it actually? Okay, this is a powerful mechanical driver of price in the market. There is a huge surge, basically when there's a huge surge of buying call options, right? The market maker who sold those calls are now what's called short delta. Okay, they have to hedge their risk and get back to a neutral delta position. That is buying insurance on their position to maintain a neutral position. So they are forced to now buy the underlying stock, right? And this is basically on the option side. If the option buying is intensive enough, okay, they can be forced to use market orders to fill those positions, right, and creates a powerful feedback loop that actually fuels a short-term rally, okay? And this is the exact opposite, you know, when a surge basically is on the put side, right, the options on the put side, the market makers who sold those puts are now long delta, and they are now forced the market maker to sell an underlying position in the stock, which can accelerate the price drop, right, in that price. Now, delta hedging is a completely mechanical process used by market makers, but it can, again, create this imbalance in the market, causing aggressive price movements, especially when, again, there's larger movements and they have to basically get back to neutral, okay? But why is this important to us retail traders, and how do we know, or maybe, you know, why we want something like this to pay attention to? Well, this can often occur around options strike prices that have massive open interest, okay? Such as a large whole number like like 100, 150, 200 levels, okay? And as price moves towards these levels that have a lot of open interest, you may see a surge in volume on the option side, right? And this is your signal because market makers at that point are going to start to hedge. You're going to start to buy this insurance on their positions. And this hedging, right, of buying and selling from the market makers themselves can push and drive basically that that stock to the next level, right? Triggering basically all the stops and creating more momentum for the next big move, right? So this isn't like news-driven or catalyst event or something that, you know, is going to drive the market, okay? This is basically, we're getting in front of the market maker's own mechanism, okay, and the reaction to price. So when we're coming up basically on front month options, right, expiring, or we're coming up on a major level where there's a lot of open interest on the option side, there is a potential there, right, for some sideways movement and then a breakout because the market makers are trying to get back to a neutral delta. And sometimes to do that, they have to get into the market with some aggressive short-term market orders. That's what I want you to take away from here. All right, next, let's hit a topic that I know everybody likes to talk about, and that is stop hunting. Yes, it is real, right? And yes, it is legal. All right, and we hear about it all the time. Oh, that doesn't happen. It's completely real, okay? The reason it feels like you're always getting stopped out is this is the market algos mechanically exploiting predictable behavior by retail traders, right? Now, stop orders, right, are market orders, okay? They do not show up on the level 2 book, okay? The depth of market book, they don't show up because they're market orders. Rather, large players know that retail traders tend to cluster their stops around obvious support and resistance levels, right? That's very common. It's under the VWAP, under the 200 moving average, whatever it is. It's going to be very common where you're going to be putting these, okay? So it is, again, very common for institutions to drive price, intentionally drive price either up or down to run the stops, okay? And then that triggers this flush of market orders into the system. This increases a cascade, right, of these orders coming in, again, driving the price to move even faster, triggering even more stops, right? So this is very classic where you'll see a flush or a spike, basically, and this is where we get like the hammer or we get the shooting star kind of pattern on the candles. Now, one classic tactic you have probably already seen, that is the opening range breakout, okay? The ORB, right? This is on basically where on the market open, okay, the price will run, right, in one direction, triggering all these stops then at that point to immediately reverse. So it's going to flush the stops, all right, and then immediately turn around and run the other direction. Okay? This is because, again, that initial flush lacked follow through, okay? Because the primary purpose was liquidation, not setting a trend. So the market makers use this intentionally, right, to create short-term high liquidity, okay, high inventory, right, and cascading a trigger basically of all these stop orders to grab that liquidity, to grab all that inventory before they reverse the direction. Okay, so while consolidated groups basically of these stop load orders, right, while invisible, are predictable pools of potential market orders, right? So this is different from dark pools, right? You know, but these are basically potential pools of liquidity that the market makers can tap into. So that's something you want to be aware of, right? That could actually accelerate price movement when they are basically running these stops. All right, traders, there you have it, a breakdown of market orders and how it affects price movement in the market and the mechanics behind it. So let's go ahead and talk about this in the comments section. Love to hear your input on this one. Thanks so much for watching, traders, and I'll see you in the next video. Take care, my friends. Cheers.